So, Assalamu alaikum everyone, and thank you for joining us today at our ShariaPortfolio Canada webinar discussing a very timely topic titled Navigating Turbulent Markets. It's no less than that, and it's certainly a topic of interest for many of our clients as well as people who may be interested in learning a little bit about us. So we'll get straight into it because we do have a lot of information to share. My name is Ishan Jan Mohammed, and I'm an Associate Portfolio Manager at ShariaPortfolio Canada. And we have Irfan Chaudhry as well joining us, hosting this webinar, and he's a portfolio manager. Both of us are part of the investment committee as well. We will be discussing and we'll be presenting a couple of different points that are of interest to all of you, after which we will leave the floor for questions. So we'll try our level best to get through this and have enough time for you at the end. To ask questions, you should be able to put it into the Q&A box on your screen, and we'll see the questions come right to us, and we'll try to address all of them as best as we can, inshallah. So we'll get started right into it. Before we begin, just a quick disclaimer. Um, just for formality purposes, but just to let you know that the information we share is for educational purposes and is not to be construed as specific investment advice for your own circumstances. We will be going through how our portfolio was positioned before the trade war, how it was positioned in February at the peak of the market. We'll go through a couple of points with regards to investing discipline, how you should actually be what approach you should be taking with regards to your portfolio during times like this. The Trump trade war, his policies, how it impacts markets and portfolios in general. The post-trade war economic scenario and what things may look like after, and also how we are looking at ourselves positioning our portfolios going forward. And we'll discuss all of this in depth, and then we'll leave a couple of minutes for you to ask some questions as well. So yeah, I'll pass the floor on to Irfan for discussing, and then he'll jump back to me, inshallah.
All right, guys. Assalamu alaikum, everyone. And I think, as Zishan mentioned, this is very timely. We have individual chats with some of our clients, but I think we felt that it's a great time that we should do a webinar on that, so that the benefit of majority of our clients. So the first topic we want to see like how we were positioned end of last year, start of 2025. At the conceptual level, at the asset allocation level. Start of 2025, we felt that, there is a market had really done very well in last year in 2024. And the way our thought process was, and the majority and the consensus thought process was also the overweight on the credit spreads, basically, which essentially says that the corporate sukuks, they should be overweight, high yield and emerging market bonds, which are basically, again, a corollary to our sukuks, that they should be overweight. Equity, small cap growth, and GARP was considered an overweight. Also, some of the stocks which have lagged in 2024, we felt as a contrarian bet, they were considered a good choice to be in 2025. Japan, emerging markets, and the gold, these were considered overweights at the start of 2025. Some of the conceptual themes were considered equal weight, were large caps, which have done very well in 2024, but they were on the valuation front, they were considered slightly stretched. Quality trade has done very well in last year and was expected to do reasonably well in 2025 as well. European Union EFI on the geographical level, the equity spread, that should have done better as well. That was keep in mind, this was a end of 2024 and start of 2025 positioning, thought process positioning. And we were underweight, obviously, cash and duration and investment grade bonds, investment grade spooks, if you would call it, higher AAA rated, AA rated sukuks. Momentum was one which has done very well in the last 2-3 years, was considered underweight in the start of this year to 2025, and so was oil and Bitcoin. I know some of these can be kind of like at that time even we had some questions, and we felt at that time there were quite a few questions on especially on the gold momentum in Bitcoin. So let's see how many of these trades or how many of these ideas have still survived this Trump tariffs, because Trump tariffs started happening. Uh, the ferocity of them, no one expected, and with ferocity with which they were implemented, and with no sophistication there. So essentially, in March, although market started getting down before that, mid of February, after the DeepSeek came out as a DeepSeek AI, but from February till February 15 till end of April, almost like last week of April, markets were in a swoon because of that. So we put together a roll call that which of these ideas are still intact and which of them have raised some questions now. Next slide, please. Um, I think emerging markets, a contrarian bet still, I would say SPWO, which is a reflection of that in our portfolio, and small caps, tech small caps, where SPTE has a significant component there, that is still intact. That's our internal view. And a power shortage in the US, which was the start of this year, was we had some players there like uranium play in Cameco is a Canadian company, but it's one of the largest uranium producer. That has become questionable after DeepSeek, essentially. So that's questionable now. Got out of CCJ almost like I think in February or somewhere around that. And AI teams, data centers, there are some questions there as well. And semiconductors, there are a lot of questions on semiconductors as well. We reduced our exposure to semiconductors. We got out of AMD. We do not have the individual stock positions in semiconductors in the current portfolio because of the inventory issues. And also, I think some of the old semiconductors, there are a lot of inventory lying, which was done. A lot of capex was spent, and like companies like AMD, NVIDIA, and some of the other semiconductor manufacturers. So there are some questions there. We have some exposures to AI, but through other means still, but I think that we have internally agreed that those are the best way we still can retain some exposures to artificial intelligence theme and data center theme. One of them is Vertiv, which is the data center cooling. Then the deglobalization is one thought we thought tariffs. We expected tariffs, but not in this way. So this results in a certain portfolio positioning, which is still intact. Space launches, space vehicles, we were tying with this idea. I think we were caught in the middle in February. Space Mobile is one. Rocket Lab is one stock, another stock. There are a couple of others, ESDS, I think. They're small caps. Small caps were hit pretty kind of like lucky that we did not get into space launches. I think this is still an interesting theme. It's intact, but I think a right time for that, we'll see like as we go along this year, what will be the right time, because small caps were hit more than the large caps. Not large caps, I would say, but they were kind of Russell gave back a lot more than S&P 500. That's the best I can say in that. Another was contrarian, which was healthcare stocks, which did not do that well last year, including TMDX and including Novo Nordisk. Uh, HIMSS is a stock we got out actually at a very good time, and we saved a lot of profits. We made a lot of profits for our investors last year for this. And I think this was the right time when the stock went down to almost 26, 27 level. Um, I think that bet has paid off to a certain degree. These some of these stocks like TMDX is one of the best performing stocks in the portfolio this year. This is intact. Cybersecurity, Snowflake, CrowdStrike, I think those teams are intact as well, and those teams are playing. Satellite mobility, VeriSign, we purchased it. This is the best performer in the portfolio this year. That team is intact as well. Communication we noted that at the start of this year, uh, from the earnings expectation perspective, as well as from the valuation perspective, one of the sectors which was most attractive was communication sector, and it was hard to find a good name in which is Sharia compliant in the communication sector. So VeriSign is one of those names which picked up. We've done very well. Some of them are like gold currency hedges in Bitcoin we did, and I think Bitcoin still is a questionable hedge against the currency, as it's shown. It's more risk on kind of a trade, and we still feel, although there is a more adoption and there's a higher adoption, but Bitcoin itself, not a digital currency. Digital currency itself is kind of could be, but um, and the gold is also seems like overextended at this point because we'll get back to the gold, why gold price rose to the level where it is right now. We'll say a few words on that and we'll welcome the questions. And with that, I give it back to Zishan to go over the next theme in our today's presentation.
Thank you, Irfan. Yeah, so a lot of the points that Irfan has touched on, we will actually go back to those in the next slide when we're talking about how we were actually positioned during the peak of the market in February. But before that, let's just talk a little bit about what the macro background has looked like um, since 2024, because there's a lot of developments that have taken place and a lot of things that have happened in the market. And I'll just kind of go through them very quickly, just to give you an idea of how things happen and how they're impacting our portfolio and the markets in general. So we've gone through a lot of talk about US inflation, the tightening and then the loosening of the labor market, rates outlook, and how the Fed's decisions have been changing based on their data-dependent policies. All of this combined with potential stagflation risk as well. We've seen how Trump's policies bring us to the brink of tariff wars, deglobalization, and then at the same time, we've also had exposure to geopolitical challenges in the Middle East, the war with Russia and Ukraine, deflation in China, the monetary easing on a global scale, but especially in emerging markets as well. Last year, we also went through what was known as the Japan carry trade unwinding right before us, right? That impacted a lot of the markets as well because a lot of selling that took place, especially on the US markets. We've had supply chains that have been at risk. We've had deregulation in the US with regards to fiscal policies as well. Asset values, of course, have remained elevated in the developed world, especially, and that has also taken its toll on inflation. And it's something that the Feds have been trying to lower as much as possible. So there's a lot of things going on. And when a lot of things are going on in the market, combined with uncertainty, that is a recipe for volatility in the markets. So these are very, as I said, right, the title of this webinar is very timely because they are indeed turbulent markets. And it's about how we manage portfolios, how we manage our goals, and how we manage the entire financial aspect of our planning. Because at the end of the day, all of this matters to us because we're investing funds for our future. And it's important that everything is managed accordingly. And number one, keeping in mind risk management, right? Which is one of the topmost challenges that we have as portfolio managers. So touching back on what Irfan kind of already spoke about, a lot of those points are already here, but how are we positioned in February and how are we positioned going forward? We strategically increased our allocation to our SVWO security, which is for a global equity exposure. That has helped us quite a bit, especially in trying to mitigate our high level of exposure to the North American markets. We also increased exposure to SPRE, which is REITs. At the same time, Irfan also mentioned this, but with DeepSeek coming out, we also had to reallocate some of our exposure from data centers away from that in order to be able to diversify well enough, but also to mitigate some of that exposure because we don't want to be overexposed to something which, like I said, risk management is the most important thing. So we try to mitigate our risk wherever possible, but still have exposure to it because of the potential in that sector. So that also meant reallocation from semiconductors. Our position in HIMS as a contrarian play in the healthcare sector, we had a position in HIMS which we did get out of with decent profits. We still hold Transmedics and Novo Nordisk. Transmedics is actually one of our best performers this year. Like Irfan also said, the communication sector is something that is very hard to find something Sharia compliant in. So to find a good quality company to invest in is a really big deal in that sector. And we do have a position in Verisign which has performed really well. And not only has it performed really well, but it's actually one of our high conviction positions as well. If you're a client of ours, you would have noticed that we've actually been maintaining a pretty decent cash position in our portfolios. And that is since the peak, actually, not only just since the peak, but even a little before that. And that was a very strategic play as well. We maintain this cash position because when we go through times and periods of volatility like we are right now, that's when you actually get opportunities. Because if the market just keeps going up, you don't actually get the opportunities you're looking for at decent valuation levels. So we maintained these cash positions. At the same time, we also used the option of reallocating from specific assets to other assets. And that has helped us quite a bit in terms of our performance, as well as trying to mitigate as much risk exposure we have in our portfolios. So just a general look for you guys in terms of what our top performers look like in our portfolio. So when this chart was generated, the S&P 500 was actually down about 6.7% year to date. At that time, if you compare to some of these holdings, you look at Transmedics, for example, was up 48% year to date. You look at Agnico Eagle Mines, about 50% year to date. So those are phenomenal performance. At the same time, you've got Verisign and Telefônica Viv Brazil. These are two companies that have run around the 28 to 30% range, which is phenomenal considering the market we're in. So that's why it's always important to be diversified not only across asset classes, but also across different sectors and regions. Then you'll also see one of our purchases, Calmain, which we actually had before and got out of, but it's something we got back into. And if you look here on the screen ahead of you, we actually bought Calmain at the beginning of March. So yes, year to date, it's down about 10% because it had dropped right off of its very high because it was very overextended. And we got back in it. So we're actually sitting on a decent return on that considering the market we're in. If you look at Verisign as well, we purchased that in early 2025, which is a perfect entry considering we're at about 30% gain on that right now. So this is just to give you an idea that yes, in general, the market is down. There are performers, there are positions which will not be performing as well as we'd expect or as you'd hope, right, in your portfolios. But at the same time, the way to manage the portfolio is very important in terms of risk management, asset allocation, and diversification, because you will have companies that still do perform well, even when the market is not performing well. And this is just an example of that. Now, my favorite topic is investment discipline. And if you've been on the past few webinars that I've been on, you'll notice that I really, really emphasize investing discipline and having a long-term view. And this is not just out of thin air, but it is backed by data, which I have shared before. Now, I'm not going to go into every detail that I've shared before. If you do want to learn a little bit more about investing discipline, how not to time the market, we have a webinar that's specifically for that. I'd encourage you to go and look at that. But in general, one of my favorite slides is this one. If you look at the graph on the left, that's from 1991 to 2021, so approximately 30 years. What this graph is telling you that if you start with $10,000, for example, and you stay invested in the market, you just stayed invested. You did not move out, buy, sell, you just stayed invested in the market, you would end 2021 with $60,000. Now here is and sorry, this is not the S&P 500, it's the S&P TSX Composite. But the same applies to other markets because the data is honestly very similar, and you can see that in the previous webinars that we've shared. The interesting part is that if you only missed 1% of all the trading days, of the top trading days in that 30 period of time, instead of 60,000, you'd have $3,700. That's by missing 1% of the top trading days over the past 30 years. That's a huge number. In general, if you miss 10 of the top trading days, your returns are halved. Instead of 60, you'd be at about, let's say, 30,000. General rounding of numbers here. So the important thing here is to make sure you're invested. If you look at this graph over 30 years, you look at all the ups and downs, you'll see periods of volatility. You'll see COVID right there as well, around 2020. You can see that drop. That was unprecedented. You know the saying about it's different this time? That was very different at that time, COVID. It was very different. But at the end of the day, you have to maintain perspective. As long as you're in a portfolio that matches your risk tolerance levels, you have to maintain perspective as long as you're on track to achieving your goals. One of the most important stats to share here is that the best days of a market, the best days in terms of performance, actually happen majority of the time during a bear market. And that's very key because it's important that even during periods of volatility, when you're seeing negative, to remain invested is important because 50% of the time, the best days of the market come at that time. And as we've already mentioned, it's important to be invested because if you miss the best trading days in the market, that in the long term really does negatively affect your performance. So I'll give you a quick example. April 9, not too long ago, a lot of you may have been aware of this, but April 7th, 2 days before the day that's circled here, we actually touched bear market territory. And what happens 2 days after that? We have a 9.5% day in the S&P 500. Yes, we had some good news with regards to a pause on tariffs from Trump, but 9.5% in one day on the S&P 500. The last time we had performance similar to this at this level was in 2008, which is a very, very long time ago. Of course, it's not too long in our minds, but it is technically a very long time ago. Now, if you're not invested in the market, you're missing that 9.5% day because the market does not tell you before it's going to do that. I'm just trying to put things into perspective. Now, like I mentioned, over the long period of time, in the larger scheme of things, market corrections are actually not that material. So if you look at the graph on the bottom right, that's the S&P 500 since, let's say, 2019, right before the COVID crash. The market currently, when it dropped to its bottom not too long ago, it dropped at a very strong support line. If you look at this trend line here, the blue dotted dash line, right? That's it. That's a trend line that's held very strong because the market actually bounced right off of that. And it also bounced off another key level, which is the high of 2022. So the market needs to move up and down in general to be efficient over the long term, but not only that, because that provides you with opportunity. On a daily basis, ups and downs in the market are just people buying and selling. So it's important, once again, to maintain that long-term horizon. Because when you try to time it and go in and out of the market, it's going to be very, very difficult to actually get the bottom or find the top. Now, I see one question here, which I think I should answer. The question is, what's a trading day? A trading day is basically any day in the market. So for example, the market opens today at 9:30 a.m. and closes at 4 p.m. That period of time today is a trading day. So whatever the market does during that day, it either goes up from where it was yesterday or it goes down from where it was yesterday. And that would be your performance. So in terms of the previous slide, I assume that's what the question's about, is how not to avoid missing the best trading days. Every day in the market, every day the market is open is a trading day. But I hope that answers the question. Now, if you look at the graph on the left, right, this is the average S&P 500 returns following 21 corrections of at least 10% since 1980. The first three bars are very short term, so 1, 3, and 6 months. I don't like to focus on that much. Let's look at the minimum 12 months. So if you actually look at the minimum 12 months, every time, well, over these 21 corrections of 10%, the market has actually performed 14% from there over a 12-month period after that. And if you look at the graph on the right, a 10% correction or a drawdown is actually not abnormal. That the S&P 500 has a median annual drawdown of 10% during the last 40 years. So ups and downs are very normal in the market. Today we've got tariff news, tomorrow we'll have something else. And the year after that, there'll be something else and something else, because that creates volatility in the market. But like I said, without volatility in the market, there's no opportunity. So it's important, once again, to put things into perspective, manage your portfolio well according to your risk profile, and ensure that the portfolio manager is taking care of your portfolios. Keep risk management as the first point of concern, because risk management is most important, but after that is to make sure you're staying invested. You have to hold a quality portfolio. So moving on, to give you an update again, or kind of like a briefing on what happened. So on April the 2nd, Trump announced a US reciprocal tariff plan, which was basically a 10% tariff on all countries, which would have been effective April 5th. So generally, it was a 10% tariff on all countries, and that basically means that if if I, as the US, am going to import products from outside of the US, I will now pay an additional 10% as a company importing those products to get those products in. So it's more costly for me. So in general, he included a 10% tariff on all countries, but there were some countries, a lot of countries, which actually have a larger trade deficit with the US, where he had a much higher tariff level. Now, the market already knew that tariffs are coming because it was already playing out in the news. But the amount of tariffs that he did incur upon some of these countries with larger trade deficits was a lot more aggressive than was expected, and that drove a lot of volatility in the market. Now, in general, the entire world is exposed to uncertainty when it's brought on by Trump and the US's basically disregard to other nations' interests. Now, keeping all of this in mind, it's important to know that when you're invested in the market, you will be exposed to volatility and ups and downs. Now, what we can do best is to try and minimize and mitigate that risk as much as possible. You can't, there's something known as risk that is possible to be diversified away. So when you diversify your portfolio enough, that risk goes away. But there's some risk which is market risk, which is not possible to avoid if you're invested in the market. But we do our best to make sure that we mitigate that for our clients and still perform better than the market as much as we can. Our aggressive portfolio was down less than the S&P 500 during this time. So to give an example for, let's say, anyone who's kind of a beginner here, just trying to learn, if the market is down, let's say the market is up 10%, and your portfolio is down 12%, you have outperformed the market by 2%. Let's say the market's down 10%, but you're down 8%. That means you've still done better than the market. Now, our aggressive portfolio, in terms of the holdings and performance of those individual holdings, performed better than the S&P 500. So during the period of February 19th to April 6th, the S&P 500 was actually down 17.5%, and the QQQs, which is basically, keep it simple, the NASDAQ, the tech side, was down 20%. And for February and March in general, it was down 10%. Our portfolios performed better than that. And a lot of this was because our positioning in the portfolio had higher cash, as I mentioned. We had strategically made sure that we are positioned with a higher cash allocation, as well as a higher allocation to SPWO, which is global equities ex-US, so outside of the United States of America. and our allocation to specific companies that are tariff resilient, as well as in a stronger position to weather storms and volatilities in the market, like Calmate, Novo Nordisk, Telefonica, and VeriSign. So this is kind of to give you an idea of how we actively look to make sure we're doing the best we can to mitigate risk. Because a lot of times we get questions from clients or people who are looking to work with us, like, what are we doing during times like this? So one thing is important to know that the portfolio management team is actively monitoring portfolios and looking to mitigate risk, as well as looking to make sure that our performance is top notch. But at the same time, as a client or someone who has a portfolio invested, what can you do? And what you can do is what we've spoken about over the previous slides, is to maintain investment discipline, to maintain a long-term approach. And on the portfolio management side, at all times, we're monitoring the market to make sure that we're mitigating as much risk as possible, diversifying your portfolio, and trying to get the best performance you can out of this market. Now, before I pass it back on to Irfan, I'm not sure if I'm talking too much, but we've got the VIX indicator. And this is a good way of kind of checking for yourself even of where the market is with regards to uncertainty or volatility. The VIX is in general a fear gauge of the market. Now it measures how much investors expect the market to move based on S&P 500 options. I don't want to get too much into detail of that to explain the nitty-gritties, but in general, the VIX, VIX, is an indicator of fear or uncertainty in the market. And if you look at the graph here, you'll notice that during all of these times of uncertainty or volatility, you'll see the VIX is at a very high level. Currently, we're sitting at about 25, but it's still elevated compared to the last 18 months. So that means volatility is still in the market. But today, specifically today, it's not as high as it was, let's say, a couple of weeks ago. And as things that are uncertain become more certain over time and the market finds stability and stabilizes a bit, the VIX generally does come down. Now, I'll pass it on to Irfan to speak a little bit more about the world central banks with regards to gold, as well as the US trade weighted index and how it impacts our portfolio, and then to the next section.
Thank you. Thank you, Zishan, and thank you for sharing a lot of insights, actually, which are great insights into the portfolio positioning, and I think gets our investors basically a peek into our thought process here. So these charts, three charts, VIX, gold, and I believe US dollar, they were of particular interest to our Canadian investors. VIX is obviously just to show you guys that how much the uncertainty and risk and fear in the market. Uh, which is moves up and down. Still, it's a 25, but it still can shoot up again because there are a lot of things there which are not stitched so far in the trade war, and it can keep. But it's probably, I think, the peak of the purpose of showing the chart is that peak of 45, which is the at the height of the tariff risk when it was kind of no one knew that it's going to be 245% or 500% tariffs because the way tit for tat tariffs were going on between China and the US, it seemed like, one side was raising it 100%, other side was raising it 100%. So that's where it touched 45, and 45 is pretty high. And then right now it's still elevated, but I think we are not, our risk is probably we have seen the peak of the uncertainty. In regards to the US dollar, go to the next chart, please. Uh, in regards to this gold and US dollar, these are two questions. Gold, they're connected basically because gold has served as the central banks were picking up. That's the additional measure of purchases uh, by the central banks which were absent last years. So they started very aggressively picking up the gold in the start of 2025, which caused the gold price to spike from somewhere it was 25, 2600, and then went down almost to 32, 3300. We were invested in gold most of the time last year. Uh, we in February, I think we repositioned our gold because we thought the gold is overextended, but uh, you absolutely cannot be right on that front because maybe we potentially could have kept that position. But I think we didn't want to really catch the departing trains basically and run after that. So we potentially did not get back into gold after that. But at the right time, if we feel that there is a risk is made desirable, especially in regards to currency. If the US dollars decline, if you go to the next chart, if we think that US dollar is going to go down and really collapse, then gold can be a potential where we can really get in there. The US trade, there's a second discussion, a lot of discussion on the US dollar itself. I've just put together a chart of US trade weighted dollar index, which is US dollar against a basket of currencies, weighted by like how much trade US has with the different countries there. So it's like it's not an extended level. Uh, it's still on the higher side, but it's not a two standard deviation or even when one standard deviation away from the mean. So I think that the fears of U.S. trade, U.S. dollar being really going down as a currency, they're really overdone and they're elevated. There's a lot of discussion at that, but I think it's overdone. Still, 80% of the interbank transaction in the world happens in the US dollar. Uh, and still the settlements, almost 50% of the global settlements happens in the US dollar. The Chinese yuan is just a 4% of that still. So maybe over time there may be some shift because generally there's a shift happens to the trading countries like happens from pound to US dollar, but that's a long-term process. That's not an overnight process, and you can't really play that trade into at this point in time. Next slide, please. So we probably just wanted to touch these three things just to give you guys an idea. If there are questions, we can tackle them later. There are certain tariff risks we've already mentioned before. Inflation is the peak risk because of the tariffs. And I think there are a lot of questions on the different press briefings by White House on the inflation. Then they forced Amazon to take down that price line, which would depict the impact of tariffs on the prices of the things people purchase through Amazon. Um, so inflation is a very real risk, and it has affected the stocks like Walmart, for example. Uh, Also, there could be other stocks as well, and the grocery items, a lot of small items, small scale electronics, they would be subject to inflation. US GDP growth may be revised downwards. This is a risk, economic risk. Stagflation, as Dishan mentioned earlier, is a risk. Supply chains, where the US ports are getting emptier now uh, because the world trade has touched almost a rock bottom at this point in time. So that's kind of like another risk that supply chains could be disrupted, just like what happened during COVID. Uh, US treasuries can really, the 10 years yield can go up because of the selling of treasuries by some of the holders as a part of the tariff trade war. Corporate profit margins can be squeezed because not 100% of the tariff price increase because of tariffs would be absorbed by the consumer. Consumer still 65% of the consumption is still of the US GDP. That can see a risk because the decline in the income plus the increase in the prices side. So there's kind of like some estimations that, how much a recession would impact different countries' GDP by. So that's a real risk actually, and that part of the kind of that risk actually, when we put together these slides, that was somewhere end of last week of April, but we can see it today, markets negative reaction to first quarter US GDP, and it's a negative reaction basically. So that's I think this slide is about. Next slide. This is a chart, actually table, and that would show you like when we started this year, if you look at the US, it's 1.9% you here and 1.7% in 2025 for US. Uh, this is revised actually because at the start of this year, this was 2.6 and 2.8 actually in 2025 and 2026. So I think already some of that has been absorbed by at the macro level, but still market may not have absorbed it completely as the reaction of market to the Q1 GDP in the US as depicts right now, it's a red market today. Next slide. But still, the point here is not that all the risks that we are mentioning, a laundry list of the risks, that risks are still there, but that does not necessarily mean that we are heading to a recession. There is a probability of recession which has increased from the start of this year, but still, I think consensus says that we will have soft economic data and some risks there, but we are not, US is not headed to the recession, and neither does the world is headed towards the recession. Second is the trade and its impact. I think there has been some questions, and why I put together these numbers here is that all the countries in the world are exposed to the trade and drop in the trade if the world becomes completely fenced in. Every country becomes fenced in. So different levels of exposure, but I think there are exposures for every country. And that exposure is not higher for Canada or compared to China, compared to the US, as you would see with the numbers here. So the important point here is that we select right regions where the impact is minimal. Uh, like the US, I would say that probably the impact is lower than China and India, but there can be other compelling arguments in the favor of emerging markets for giving them an overweight exposure to the portfolio, but not regards to the trade risk. Next slide, please. So yeah, there is a fluctuation in American policy as well. Like there is no consistent American policy, I think, and that policy uncertainty itself has caused a turmoil in the markets. But that's now the market has started seeing through that policy uncertainty. But the hard data would still be there. Would be surprises and can be surprises on the hard data front. So next slide, please. Um, I think there are three ways. We saw that there are three ways this trade war can be settled. First is obviously deals, which White House been trumpeting all along. The courts or Congress can intervene at some point, as they did in the case of suspending the tariffs on Canada. Also, I think Trump can ultimately may give some incentivize historical realignment of the trade and reshoring of the manufacturing, especially the low value manufacturing to within the United States. I think it can be combination of one or two, but it can long term, three could also be the possibility, which is not at all completely bad for the US, but actually in the short term, obviously medium term as well, like in 3 to 5 years term, which is pretty long term from the investor's perspective, that can keep creating volatility during Trump's time. But I think if you go to the next slide, please. I think that we have seen the peak tariffs, so peak time of volatility is already done. That was Q1 in early April. Q2, the focus will ultimately shift towards the budget and deregulation and the benefits which the companies can get from deregulation. There's a significant benefit and the tax cuts. I think this shift of focus there would essentially also put a calming kind of a influence on the market as well. So there could be some days like today where when the data comes out Q1 GDP, which would create volatility. But largely, I think the focus is going to the second quarter of 2025 is going to shift towards the budget and budgetary proposals, so which will calm the market. Next slide, please. Okay. So another angle is I think that's when I did discuss the risks. I skipped Powell versus Trump, that Federal Reserve Bank versus Trump, when Trump wants to force Federal Reserve Bank to cut rates more aggressively. That's one of the risks, but I think ultimately Federal Reserve will probably will cut the rates more aggressively than they're at the time they're resisting it, but I think in the third or fourth quarter of this year, second half of this year, I think we'll see a few more cuts penciled in this dotted line here on the right. And I would say the neutral rate should come down a bit more from the current neutral rate, which is and the current absolute rate, which is 4.5%, which should be positive for the valuations of the companies. So second half probably can see a third or fourth quarter of this year, there's some expansion in valuation back because still, if you go, there's some description there that valuation right now has come back to 19.7 level forward price to earning ratio for S&P 500. That can potentially be expand again to at least 20 level because of the impact of discount rates and the decline in the rates in the fourth quarter more than what is expected today. Next slide, please. So this is what I was talking about, the budget fiscal impact of deregulation. So that's gonna be, there could be there's a benefit, a bonanza for the companies here. And obviously there's a negative from the tariff side and the inflation side, but on the positive side, there's a reduction in the company's expenses where probably can help in improving their margins. So that's positive for the overall stock market general. Next slide, please. Yeah, if you look at this from the valuation perspective, if you would see that, most of the Myers MSA EFI, MSA EM, S&P 500, all of them, they looks pretty attractive at this point in time. On the relative basis, still, if you would, EM is still a better choice. That's what I mentioned, that there are some high risk, but still emerging markets, and that's why we're going to keep a higher allocation to SPWO in the portfolios. Correlation of S&P 500 stocks, they have gone down a little bit, but also that's positive for S&P 500 because if the correlation is very high, that's generally negative for the breadth. And a lower correlation generally argues in the favor of stock selection, which we had been focusing on lately, and focusing on alpha rather than the beta for the portfolio performance this year. Next slide, please. This is just a slide I took from FactSet, some data. So there's some downward revision in earnings per share, and this is some argument which I made earlier that S&P price to earning ratio would expand back to year end to maybe 21. So based on that, I think we still at beta level, S&P 500 level would be a decent return for this year, not comparable to last year, but still a decent return, a positive decent return, and nothing like a negative 15%, 20% like of 2008. So we are not in 2008. Next slide, please. Yep. So having gone through that, I think this is the most important slide, like the thought process, how we are looking at from the portfolio. We have 2-3 minutes more, and just breeze through that. Like some of those positioning has already happened. We have concentrated the positions at the higher conviction level. We are in the process of keeping doing it. Like some of the names, like PayPal, for example, we built a position, 4% position, TMDX, Vertiv, like a lot of those positions, Colmain, we have concentrated the positions. We have increased our holdings to SPWO. US still is a good investment. I believe so. I think there are cons for that, but there's also positive for that as well. We staying out of semiconductors, and we have very mild exposure to artificial intelligence. We'll keep looking at the stocks which are localized, like Colmain, for example, or VeriSign, or Telefonica Brazil, where the effect of tariffs are minimal. Small caps versus large caps, this argument has happened earlier. I think Although we see a lot of gems in the small caps, but we will see like if we have a very high conviction at that level, that we can pick up bigger positions in that. Mag 7 at the stock selection level, we may be staying away from that for the time being because those are global companies. And besides valuation and deep seek risk, there's a third risk of the deglobalization, which is much higher for Mag 7 or any bigger companies as compared to the smaller companies. Healthcare, we are for that healthcare. We already have a good position there, and we'll keep our positions there, and maybe we can build some of those positions, like some of the stocks we have discussed lately. I think one of them is not Sharia compliant, and we're discussing some of those stocks which are consumer discretionary but more resistant to the exposures there. Commodities as a hedge, yes, but there are risks there as well. So we are pretty much kind of slightly ambivalent that we have a position in AEM as there. We have a position in ZOM, ExxonMobil. So I think that's uh, I would leave it there for some of the thoughts here, and I think some of the thoughts as we go keep evolving. But I want you guys to be rest assured that our investment committee is very diligently working on each small strands. These are like the small strands where we build and we sew them together to build a very strong rope here. And that's rope basically safeguards your portfolio's value, capital preservation, plus the returns this year. Next slide, please. Uh, Okay, this is my final word here that stock markets drawdowns can be jarring, and it is jarring not only for the professional investors like us, it's more jarring to people who are not professional investors. We've been through the different drawdowns throughout our careers, like multiples drawdowns, huge drawdowns like 2008. I've seen 2008. Zishan might not have seen 2008 crisis, but he would have seen some crisis later. I think the best strategy is to always staying invested. Basically, that's he is, and I would highlight it and well-diversified portfolio and quality investments and always avoid making emotionally charged investments. That's the human instinct. And no, I'm not faulting anyone for that. That's the first human instinct that, fight or flee. So flee is one, like one tries to take a flight, sell everything, go home, but do not make emotionally charged investment decisions. So stay invested in the market because staying invested in the market has proven to be the best strategy in at least in my career, which I've seen, and I think other people's career as well.
Well, thank you, Irfan, for the insightful information you've added there as well. We will open the floor for questions. You do have Irfan's contact information as well as mine on the screen in front of you. Feel free to reach out directly if you do have any questions or concerns that you'd like to discuss. The floor is open for questions, so if you do want to, you can add your questions into the Q&A box. There are a couple of questions already in queue, so I'll just go ahead and start with them very quickly. The first one, Irfan, maybe you just want to answer this very quickly, but the question is, can
Muslims
you
are allowed
please,
to invest in the gold, actually.
yeah,
If that's the question, can
yeah,
you
maybe you want to answer the one about investing in segregated funds and gold if it's Sharia compliant.
you may take it, Zishan. I think you're better
Sure.
qualified than me. Yeah.
So segregated funds in general, it would depend. Most segregated funds are not going to be Sharia compliant, but if you have a specific one that you'd like to get an idea on with regards to Sharia compliance, feel free to reach out. In general, most of them have interest-based securities under their holdings, but that's not to put out a blanket statement. There may be some that are compliant, so it would depend largely on the one you're talking about. Gold, yes, it is compliant to invest in gold, but even with gold, it's important that when you're investing in gold, if let's say you're investing in a gold fund, you're investing in a gold fund that is compliant in terms of potential hedging against the currencies or different instruments that they use in that model. But in general, gold is Sharia compliant to invest in, as is with other commodities. So I hope that answers that question. We'll go to the next one. If someone is planning to bring investments from other institutions to Sharia portfolio, considering the market is down now, what would be your suggestion to make this move? Should they wait and see if the market goes higher to avoid selling the loss?
Okay,
So, in terms of transferring from another institution, you shouldn't really be worried about realizing any losses there because when you transfer from another institution in Canada, you can transfer in kind, which means your portfolio would move from that institution to us as is, but that depends, of course, on the holdings that you're holding at the other institution as well. So once again, if you can and you'd like to explore your options, do reach out to me. You have my contact information. I'd be more than happy to help you and see what your best option would be. But in general, yes, you can move things in kind without having to sell while the market is down. Next question. Irfan, maybe you can answer this one. I work in
okay,
the
okay,
semiconductor
no worries.
field. Is it sure it is surely volatile? What about agentic AI field?
Well, I think there are components of AI which are still interesting, and not only artificial intelligence like as a likes of where it's being used as an application to enhance the productivity. I think it's being used in which probably can help increase in the margins for the companies. So I think we are looking at that, and we are keeping some of the holdings where AI can be used to complement the margins, basically, like Adobe, for example, or there are some components like agentic AI can be being used in companies by companies like um, Aristanet, for example. Um, we potentially think that's a still a more insulated to uh, the risk compared to the companies which are directly like the semiconductors, which are maybe oversupplied right now, and to a certain degree, direct connection to the power generation, which is required for the data centers, which is presumed to be the bedrock of the language learning models for testing, training the LLMs. So that's kind of like, I think, more riskier for the portfolios at this point in time. Um,
Irfan, do you want to take the question on markets being turbulent and staying
Okay,
invested?
I shall take that. No rush answering. When markets are turbulent, we often advise importance. Yes, please. The If someone is near retirement, the best advice is to get to a lower risk portfolio. Lower risk portfolios are less exposed to the market, much less exposed to the market, and uh, much quicker turnaround time, like from the curve from the drawdown. So essentially, I think if you are retiring in 2 to 4 years, you should be either in a moderate or a conservative portfolio, in a more like an income portfolio, not a conservative, if you would, depending on like where in the scale you are or where you rest of the rest of the parameters, like how much income you need to draw from your portfolio and how much is total your assets. So depending on all these, I think you potentially have to be allocated according to the risk uh, you have in your portfolio, and that risk basically makes you uh, gives you more time to recover from the volatility or drawdowns. Like obviously, if you are, I've take this question on the face of it, if it's just a 2 years remaining for retirement, I would rather have it in a income portfolio, basically, where it's like just goes down maybe 1, 2, 3%, maybe that much from the and during this drawdown, not 7, 8% or 6% or 5% or 8% or 10%.
Thank
Um,
you, Irfan. We are a little bit over time, but we have just a couple of more questions, so we can try to get through them very quickly. One question is, um, and there's two questions with regards to Bitcoin, so I'll answer both together, and then Irfan, if
yes,
you want to
please.
add. One is crypto ETF Sharia compliant? And one is Bitcoin is predicted to boom if the Trump administration would enable it. Any plans? So In our aggressive model, we already do maintain a position in Bitcoin, so we have some exposure to it. Um, Crypto ETFs, whether they're Sharia compliant, again, it depends on that specific ETF. The ones we have in our model are compliant, of course. But if there is a specific one that you'd like to discuss, feel free to reach out once again and we can go through that with you. But in general, yes, like Bitcoin and Ethereum are compliant with regards to being able to invest in them.
Okay, Shakib's question is Bitcoin is predicted to boom if Trump administration would enable it. Any plans? Shakib, we still have a position in Bitcoin. We are not out of Bitcoin in the portfolio. We are weighing different outcomes. And I think obviously if Bitcoin is more established our adoption side, like one of the arguments in the favor of Bitcoin is adoption. So if its adoption increases as a result of Trump's administration's actions, that's definitely going to be helpful to Bitcoin. But also, I think there are stable coins or coins which are being backed by Federal Reserve, which can act as a competition to Bitcoin. Bitcoin itself won't be necessarily negative for the blockchain or the digital currency, but it potentially can be negative for Bitcoin because that creates a competitor in adoption, in the likes of stable coin or something like a digital currency, like the digital yuan, which Chinese has come up with, and they are offering a settlement in the digital yuan. So I hope that answers that question. There's another question there is liquidate any portion of any my investment during this market volatility. I strongly advise against that because based on my professional experience, I think during a market liquid volatility, it's the worst time to liquidate any portion of the investments.
Thank you, Irfan. Last question, when you take money out from portfolio, should you sell stocks in green or red? Again, I think that ties into the question that Irfan just answered, so I think that would apply as well. But at the same time, there's many different things that come into play, right? Potential tax implications, what your position is. So I think that's a very specific question that would apply to your circumstance. So if it is something that you want to discuss, once again, feel free to reach out and we'd be more than happy to help you. I think that's pretty much it for the questions that we have, Irfan. I appreciate everyone joining our call today. Once again, you have our information. If you have any questions or concerns, anything you want to discuss, feel free to reach out. But yes, thank you for joining our call today. And inshallah, we will see you soon at the next webinar. Thank you, Irfan, as well for your presentation.
Thank you, everyone, and Assalamu alaikum.